This podcast is for educational and informational purposes only, and nothing discussed here should be considered financial, investment, or legal advice. We are not licensed financial advisors, and all opinions shared are based on personal experience and general market knowledge. Investing in stocks, cryptocurrency, gold, or any financial asset involves risk, and you may lose money. Always do your own research and consult with a qualified professional before making any investment decisions. By listening to this podcast, you agree that you are responsible for your own financial choices and actions.
Welcome to Visionary Business Perspectives, where we look ahead at the trends shaping the economy and markets. I'm your host, John, joined today by Adam, a visionary business strategist. Over the next, we'll explore stock market outlook for 2025 to 26, gold's role in inflation protection, the future of crypto and blockchain, AI and automation in business, and the rise of the digital economy and a cashless society. We'll also talk about wealth-building mindsets and how to prepare for expected shifts in 2026.
Thanks, John. It's great to be here. Our goal is to provide educational insights and motivation. Remember, nothing we say today is financial advice. It's for information and inspiration only.
Absolutely. We're covering a lot of ground. Let's dive in with the big picture on markets.
Many strategists are optimistic. For example, Morgan Stanley recently raised its S&P 500 target for year-end 2026 to about 7,800, around mid-teens percentage gain from current levels. In fact, Wall Street forecasts cluster around 7,500 to 8,000 for 2026. So consensus is still bullish overall.
The stock market has had a phenomenal run, especially in 2023 to 25. What are you seeing for 2026? Will the gains continue?
We've seen a rotation. Late 2025 saw the Magnificent Seven tech names cool off, while sectors like energy, healthcare, and utilities outperformed. This could indicate healthier market breadth going into 2026. But tech is far from out. Companies enabling AI and automation are still market leaders.
The stock market has had a phenomenal run, especially in 2023 to 25. What are you seeing for 2026? Will the gains continue?
NVIDIA has been a standout. In 2025, it broke the $4 trillion market cap barrier due to its dominance in AI hardware. To quote one analyst, NVIDIA became the toll booth on the AI highway, powering virtually every major AI model. In contrast, Apple remains the world's richest cash machine, hitting about $4 trillion too. But its story is about steady cash flows and gradual improvements. Apple's growth is stable and beloved by the market, but it hasn't had a new supercycle spark. It just keeps printing strong profits.
Is this driven by big tech, or are we seeing a broader market?
Tesla's 2025 was a wild ride with volatility. Analysts are divided. Some remain bullish. Wedbush's Dan Ives calls 2026 a monster year for Tesla if its AI and autonomy products perform. Prediction markets in late 2025 showed a 97% chance Tesla would hit around $465 in January 2026, indicating trader confidence. On the other hand, Wall Street consensus is more cautious, targets around $399 on average. The key is Tesla's execution in robotaxis and robotics. In short, Tesla's valuation already prices in a lot of future success. If it delivers, that rally could continue. But if EV sales languish further, we'll see pressure too.
Speaking of tech, how about the giants like NVIDIA, Apple, and Tesla?
We always emphasize diversification. Even if strategists see mid-teens gains for the S&P 500 next year, markets can correct. Keep cash for opportunities and balance growth with value or defensive assets. For instance, Ray Dalio now suggests revisiting the old 60-40 stock-bond split because bonds look very risky with high debt. In any case, many analysts advise focusing on quality fundamentals.
So, strong tech, cautious optimism, more sectors picking up slack. How should investors think about this?
Gold is certainly shining. It's up dramatically. In 2025, it rocketed about 67% higher. Much of that is due to geopolitical and debt concerns. Legendary investor Ray Dalio has been very vocal. He warns that U.S. Treasuries aren't the safe asset they used to be and has been buying gold instead. Dalio suggests investors consider allocating around 10 to 15% of portfolios to gold. He argues that with the U.S. national debt north of $37 trillion, we risk money printing and debasement. Gold, being outside the monetary system, tends to hold value when currencies don't.
Let's talk about inflation and safe havens. Gold has been surging. Is it still the safety asset?
The consensus is inflation is cooling. Most rich countries' CPI will likely normalize by 2026. That said, many central banks still have inflation slightly above targets and are proceeding with caution on cutting rates. Gold's appeal now is partly as an inflation hedge and partly as a hedge against policy uncertainty. Remember, gold doesn't have counterparty risk, which is comforting when debt and deficits are soaring.
So gold is insurance, but is inflation still a problem?
Real assets broadly make sense. Along with gold, one might consider inflation-linked bonds, real estate, or commodities. Precious metals are the classical hedge. Dalio's Bridgewater even bought approximately $319 million of GLD, a gold ETF, in early 2025. Importantly, our listeners should balance hedges with growth. Put simply, hold some gold as insurance, but don't let it crowd out opportunities.
Any other inflation hedges?
We're seeing mainstream adoption accelerating. Major banks and institutions are getting involved. For example, JP Morgan is reportedly preparing to accept Bitcoin and Ether as collateral via ETFs. Our own research shows 172 public companies held Bitcoin in Q3 2025, up 40% from the prior quarter. That's corporate adoption driving up demand.
Crypto had a big comeback in 2025 with Bitcoin ETFs and so on. What's next for 2026?
Gradually, yes. Clear rules boost confidence. One key theme is that stablecoins are aiming to become the internet's dollar. SVB analysts predict that with clearer regulation, stablecoins will underpin payments and cross-border settlement. Similarly, tokenization of real-world assets, like bonds or property, is going mainstream. 2026 could see tokenized assets leap as blockchain platforms evolve.
And regulatory clarity. Is it better?
Analysts like those at Bitwise are bullish. They predict 2026 could shatter Bitcoin's 4-year cycle pattern, sending it to new all-time highs. They also expect Ethereum and other crypto majors to rally, especially if regulatory frameworks continue improving. To be clear, these are predictions, not guarantees, but the tone is that crypto's long-term tailwinds, institutional flows, ETFs, blockchain use cases, are strong.
Bitcoin and Ethereum prices?
Always. Crypto volatility will remain. Predictions markets, like Polymarket, indicate people see upside, but crypto can swing based on news, for example, if central banks tighten more than expected. However, Coinbase Institutional points out that 2026's crypto gains will be driven less by hype and more by structural shifts. They highlight 3 key areas shaping 2026 adoption: improved market structure, regulatory clarity, and specific key areas like DeFi or NFTs maturing. In short, crypto is moving into a more institutional phase.
Any caution or risks?
AI is unquestionably a game changer. The World Economic Forum finds 86% of executives expect AI and information tech to fundamentally transform their business by 2030. Robotics and automation are right behind at 58%. These technologies will create the fastest growing and fastest declining occupations simultaneously.
Next, AI and automation. How will they reshape business and the workforce?
Some jobs will change or disappear, but historical patterns suggest transformation rather than outright devastation. Goldman Sachs estimates that fully deploying current AI tech could put about 6 to 7% of U.S. jobs at risk. That might nudge unemployment up by roughly 0.5 percentage point during the transition. But this displacement is likely temporary. Goldman notes previous tech revolutions typically cause a short-term uptick in unemployment, about 0.3% per 1% productivity gain, which then fades in a couple of years.
That sounds disruptive. Will people lose their jobs?
Many experts believe so. As Goldman's Joseph Briggs writes, past predictions of net job loss from automation have mostly been wrong. In fact, new job categories emerge. For example, 60% of U.S. jobs today didn't exist in 1940. WEF data predicts new technology-related jobs, AI specialists, software developers, green tech roles, will see rapid growth, even if routine clerical jobs decline. The key is training and reskilling workers.
So more jobs being created than lost?
Musk's comment that in 10 to 20 years people might view work as an optional choice is provocative. It captures a hopeful vision. If AI and automation advance, it could free people from drudgery. But it ignores human nature. Most people find purpose in working and contributing. More practically, expect AI to automate repetitive tasks and boost productivity. Goldman forecasts a 15% rise in labor productivity from AI. That means businesses will be leaner, and employees will need to focus on creative, strategic, or service-oriented roles. So in business, embrace AI for efficiency, but invest in your people's skills, because AI also raises demand for human strengths, creativity, emotional intelligence, complex problem-solving.
What about the big names? We've heard Elon Musk say things like, work will be optional with AI. How seriously should we take that?
A wealth mindset is about adaptability, lifelong learning, and optimism. Visionaries like Ray Dalio teach radical open-mindedness, always questioning assumptions and learning. For example, Dalio advises not being blinded by traditional allocations if circumstances change. Mentally, this means being ready to pivot when new opportunities arise, like the digital economy or new tech, and maintaining discipline, for example, saving and compounding early as Dalio's recent philanthropic push suggests, through U.S. children's savings accounts to harness compound growth.
Let's step back to the broader theme: wealth mindset and the digital economy. How do people prepare mentally for these shifts?
It's booming. By 2026, the digital economy is expected to exceed 20% of global GDP. Companies and governments are pouring trillions into digital transformation. That means more jobs and businesses will be online. E-commerce, fintech, remote work tools, AI services, you name it. As a society, we're moving toward a cashless, platform-driven economy. For individuals, that means mastering digital skills, understanding tech trends, and being comfortable with digital payments and online assets.
And the digital economy?
Very close. U.S. data show that by 2025, 84% of payments were already digital, cards, apps, etc. About 70% of Americans even believe we're on the path to a cashless society. Globally, countries like South Korea and China lead the pack. The conveniences are compelling: reduced fraud, higher spending, etc. for businesses. But remember the drawbacks: cyber attack risk and the exclusion of unbanked folks.
Cashless society. How close are we? See?
Embrace flexibility. For example, understand digital payment tools, mobile wallets, crypto, and use them securely. Think in terms of digital assets. The wealthy often diversify into tech stocks, digital platforms, even crypto, if it suits them. Also, focus on continuous skill building. The WEF warns that 39% of skills needed today will change by 2030, so keep learning. Finally, value community and networks. A cashless economy highlights the importance of good financial relationships and peer support.
So the mindset for wealth in a digital, cashless era?
We'll see more digital wallets and stablecoins. Traditional banks will increase crypto services. For example, JP Morgan's exploring tokenized deposits and crypto rails, and banks like Citi and Morgan Stanley are building on-ramps for crypto trading. On the consumer side, expect faster checkout tech, biometrics, digital IDs. Central banks may accelerate digital currency plans, CBDCs, though any major rollout will take time.
We touched on cashless, but let's detail some 2026 expectations. What should listeners know about payments and fintech?
Businesses. Ensure you accept multiple payment methods: card, mobile, crypto, if applicable. In tech, invest in cybersecurity because going cashless means hackers target payments. Individuals, stay banked or find secure alternatives so you're not left out. And keep some emergency cash for unexpected needs. Ironically, a little cash is insurance during transitions. It's about balancing innovation with prudence.
Any timely tips for businesses or individuals?
The global economic outlook is for moderate growth, not a booming surge. Central banks are likely to continue pausing or slowly cutting rates as inflation normalizes. Watch for leadership changes. For example, possible new Fed chair in mid-2026. Trade policy remains a wild card. Tariffs and geopolitics could cause volatility.
As we near 2026, what are the key economic shifts on the horizon, and how can people prepare?
Exactly. Be constructive yet cautious. For your portfolio, diversify across assets and geographies. Consider that many strategists still see upside in equities, but also keep some defense, some safe assets like gold or quality bonds. Keep liquidity to buy on dips. Ray Dalio's commentary reminds us that markets can't rise forever without pause, so stick to fundamentals and valuations.
So a cautious optimism?
Plan for the long term. Dalio highlights using the power of compounding, like the new children's savings account program he supports. The sooner you invest, even small amounts, the more time and compounding you have. Also, think non-financial. Maintain an entrepreneurial mindset. Believe in abundance and innovation. For example, invest in your own skills like entrepreneurs do. As Dalio says, don't be afraid to try and fail fast to learn.
Any last investment-themed advice?
Change is constant and fast. But with change comes opportunity. For 2026, markets look resilient, gold is a useful hedge, crypto and digital assets are increasingly mainstream, and AI is a powerful ally if businesses and workers adapt. The wealth mindset is key. Stay open-minded, keep learning, and build resilience, financial and personal.
This has been an enlightening discussion. To wrap up, what's the overarching message for our listeners?
Thanks, John, for these insights. And thank you to our audience for tuning in. Stay motivated, stay vigilant, and here's to your success in 2026 and beyond. Goodbye, and take care.
That's great advice. One reminder before we go. Everything we discussed is for educational purposes only. Make sure to do your own research or consult a professional before making financial decisions. Thanks, Adam, for these insights. And thank you to our audience for tuning in. Stay motivated, stay vigilant, and here's to your success in 2026 and beyond. Goodbye, and take care.
This podcast is for educational and informational purposes only, and nothing discussed here should be considered financial, investment, or legal advice. We are not licensed financial advisors, and all opinions shared are based on personal experience and general market knowledge. Investing in stocks, cryptocurrency, gold, or any financial asset involves risk, and you may lose money. Always do your own research and consult with a qualified professional before making any investment decisions. By listening to this podcast, you agree that you are responsible for your own financial choices and actions.